Hello everyone, and welcome back. Today we're starting a brand new topic, financial ratios. Now, this is one of the most important topics in all of finance and accounting, so I want you to pay close attention. By the end of this video, you'll know the formula, the meaning, and a real-worked example for every major ratio out there. Let's dive right in. So, let's start with the basics. What exactly is a financial ratio? Think of it this way. A financial ratio simply takes one number from the financial statements and expresses it as a proportion of another number. How's that? Why do we do this? Because it turns big, raw rupee figures into a story we can actually compare, understand, and act on. Now, ratios help us do four things. First, compare. We can judge companies of totally different sizes side by side. Second, track the trend. Look at the same ratio over 3 to 5 years and see if things are improving or slipping. Third, benchmark. Measure the company against its industry and its competitors. And fourth, decide. Lend, invest, extend credit, or restructure. But here's the most important thing I want you to remember. A ratio is never the final answer by itself. It's a question. It tells you where to look next. Keep that in mind as we go through today's lesson. Now, there are 5 families of financial ratios, and I want you to really internalize these categories, because everything else we learn today fits into one of them. Liquidity ratios ask, can we pay what's due within a year? Solvency ratios ask, can we survive our debt in the long run? Profitability ratios ask, are we earning enough on sales and capital? Efficiency ratios ask, how hard are our assets working for us? And market ratios ask, what does the market actually think we're worth? And here's something neat I've done for you. Every single ratio in this lesson is calculated from one set of financial statements for a company we'll call ABC Limited. So you're not just memorizing formulas in isolation, you'll see exactly how all the pieces connect to one real business. Alright, let's meet our case study. ABC Limited. Take a look at the balance sheet as at 31st March 2026. Total assets are 1,400 lakh rupees. That's made up of 620 lakh in current assets and 780 lakh in net fixed assets. And how is that funded? 310 lakh of current liabilities, 390 lakh of long-term debt, and 700 lakh of shareholders' equity. Now flip over to the profit and loss statement for financial year 2025-26. Revenue is 2,000 lakh. And notice it says all on credit. Remember that detail. We'll need it later. After cost of goods sold, gross profit is 600 lakh. After operating expenses, EBIT is 300 lakh. And after interest and tax, we land at a net profit of 168 lakh rupees. One more thing to note. The company has 40 lakh equity shares outstanding, and the market price is 63 rupees per share. Keep these numbers in mind, because every single ratio from here on will be built from exactly this data. Okay, let's begin with our first family, liquidity ratios. Now, the question we're really asking here is very simple. Can this business pay everything that falls due in the next 12 months? We're going to look at 3 ratios together: the current ratio, the quick ratio, and the cash ratio. Let's get into it. First up, the current ratio. The formula is straightforward. Current assets divided by current liabilities. Let's plug in ABC Limited's numbers. 620 divided by 310. What do we get? 2.00 to 1. Now, what does that actually mean? It means there are 2 rupees of short-term assets backing every 1 rupee of short-term dues. Think about that for a second. Is that good or bad? Well, it depends. Too low, and you're warning of a cash crunch. Too high, and you might just have idle, unproductive assets sitting around doing nothing. As a rule of thumb, 1.5 to 2.0 is considered healthy for a manufacturing business. And remember, always cross-check this with a quick ratio, because inventory can actually inflate this number, as we're about to see. Now let's look at the quick ratio, also called the acid test ratio. And I love this name because it really is a tougher test. The formula: current assets minus inventory minus prepaid expenses, all divided by current liabilities. For ABC Limited, 620 take away 300 of inventory, take away 20 of prepaid expenses. That leaves quick assets of 300. Divide by current liabilities of 310, and we get 0.97 to 1. So what just happened here? We stripped out inventory and prepaid items, the slowest things to actually turn into cash. This ratio answers a much harsher question. Can we pay up without selling a single unit of stock? Now notice something important. The ratio dropped from 2.00 all the way down to 0.97 once we removed inventory. What does that tell us about ABC Limited? It tells us the company is value inventory heavy. Our third and final liquidity ratio is the cash ratio. Formula: cash plus marketable securities, divided by current liabilities. For ABC Limited, 100 divided by 310, which gives us 0.32 to 1. This is the most conservative test of the three. Only assets that are already cash actually count here. Think about why a lender would care about this. In a real stress scenario, can you pay today? Straight from the bank balance, no selling anything, no waiting on customers. As a rule of thumb, 0.2 to 0.5 is considered normal. And here's a good question to ask yourself. If it's way above that range, what might that suggest? It usually means cash is just sitting idle instead of actually working for the business. Great, that wraps up liquidity. Now let's move to family number 2, solvency ratios. Here, we're asking a longer-term question. How much of the business is funded by borrowed money, and can it actually service that debt over time? We'll cover 3 ratios: the debt-equity ratio, the debt ratio, and interest coverage. Let's go! First, the debt-equity ratio. Formula: total debt divided by shareholders' equity. For ABC Limited, total debt of 490 lakh divided by equity of 700 lakh gives us 0.70 to 1. So what's this telling us? It's comparing outside money against owner's money. This is really the core measure of leverage. Now here's something worth pausing on. Higher leverage actually lifts return on equity in good years, but it magnifies losses in bad years too. It cuts both ways, and this matters practically too. Banks often set loan covenants directly on this ratio, so if a company breaches it, that can actually trigger a loan recall. As a rule of thumb, up to 1.0 is comfortable for most industries. Next, the debt ratio. Formula: total liabilities divided by total assets. For ABC Limited, 700 divided by 1,400 gives us exactly 0.50, or 50%. What does this tell us? It's the share of every rupee of assets financed by outsiders rather than owners. Here, exactly half the company is creditor funded, and half is owner funded. As a rule of thumb, below 0.5 is considered conservative, while above 0.7 leaves very little cushion for lenders. Now, interest coverage ratio. Formula: EBIT divided by interest expense. For ABC Limited, 300 divided by 60 gives us 5.0 times. Now here's the key distinction I want you to understand. The balance sheet ratios we just covered show how much debt exists, but this ratio shows whether profits can actually carry that debt. It's expressed in times. How many times over is the interest bill actually earned? And here's a pro tip for you. A falling trend in this ratio is often an early warning sign, long before an actual default ever shows up. As a rule of thumb, above 3 times is generally considered safe. Wonderful, we've covered solvency. Now on to family number 3, profitability ratios. The question here is the business actually converting sales and the capital invested in it into real profit? We'll look at margins, return on assets, and return on equity with DuPont Analysis. This is a big one, so let's take our time. Let's start with gross, operating, and net margin. The formula: take the relevant profit figure, divide by revenue, multiply by 100. For ABC Limited, gross margin is 600 over 2,000, which is 30%. Operating margin, using EBIT, is 300 over 2,000, or 15%. And net margin is 168 over 2,000, or 8.4%. Now, what does that actually mean in plain terms? For every 100 rupees of sales, only 8 rupees 40 paisa is left over as final profit. Interesting, right? Each margin tells a different story. Gross margin tests pricing power and production cost control. Operating margin adds in overheads, showing the true efficiency of the core business. And net margin is what finally reaches the owner after interest and tax. One important reminder before we move on: always compare margins within the same industry. An FMCG margin and a steel margin simply aren't comparable, so don't fall into that trap. Now let's talk about return on assets, or ROA. Formula: net profit divided by total assets times 100. For ABC Limited, 168 divided by 1,400 times 100 equals 12%. What is this really measuring? How productively the entire asset base is being used. And here's something clever about this ratio. It ignores how those assets were funded, so it's completely capital structure neutral. Keep in mind, asset-heavy businesses will naturally show a lower ROA than service businesses, so don't compare a factory's ROA to a consulting firm's ROA. As a rule of thumb, above 10% is considered strong for manufacturing. Now here's one of my favorite ratios to teach: return on equity, or ROE. Formula: net profit divided by shareholders' equity times 100. For ABC Limited, 168 divided by 700 times 100 equals 24%. This is the owner's ratio, the return earned specifically on the money shareholders actually put in. Now pay close attention to this. ROA was 12%, but ROE jumped to 24%. Why the gap? That gap is the fingerprint of leverage doing its work. But here's the catch. A high ROE built purely on debt is fragile, not impressive. As a rule of thumb, 15% or higher, sustained over time, is considered good, but always ask yourself, is this coming from margin or is it coming from debt? That question leads us perfectly into our next topic. That question brings us to DuPont Analysis. This is where we actually break ROE apart to see what's really driving it. The formula: ROE equals net profit margin times asset turnover times the equity multiplier. Let's work through each piece. Net profit margin is 168 over 2000, which is 8.4%. This tells us how profitable each sale is. Asset turnover is 2000 over 1400, which is 1.43 times. This tells us how hard the assets are working. And the equity multiplier is 1400 over 700, which is 2.00 times. This tells us how much leverage is being used. Now watch this. Multiply all three together. 8.4% times 1.43 times 2.00 equals exactly 24% ROE. Why does this matter so much? Because two companies can post the exact same 24% ROE. One from genuinely strong margins, another purely from piling on debt. DuPont Analysis is what tells you which one you're actually looking at. This is a favorite question in interviews, so make sure you really understand this one. Excellent work so far. Let's move to family number 4, efficiency ratios. These ask, how quickly does the business convert stock, credit sales, and assets back into actual cash? We'll cover inventory turnover, debtors turnover, and asset turnover along with the cash conversion cycle. First, inventory turnover and holding days. Formula: cost of goods sold divided by inventory, and days equals 365 divided by turnover. For ABC Limited, 1,400 divided by 300 equals 4.67 times. Now let's convert that into days. 365 divided by 4.67 equals 78 days. So what's this telling us? How many times the entire stock is sold and replaced during the year. Now think about the trade-off here. Slow turnover ties up cash and raises the risk of obsolete goods. But very fast turnover can also mean stockouts and lost sales. It's a balance. As a rule of thumb, always compare with the industry. Groceries might turn over 15 times or more, while heavy machinery may only turn 2 to 3 times a year. Next, debtors turnover and the collection period. Formula: credit sales divided by receivables and DSO, days sales outstanding, equals 365 divided by turnover. For ABC Limited, 2,000 divided by 200 equals 10 times, giving us a DSO of 36.5 days. What does this actually show us? How fast customers actually pay their bills. And here's a really practical tip. A rising collection period is often the very first sign of receivable quality problems, so watch this trend closely. Always compare your DSO against the credit terms you actually offer. Here, 36 days against 30-day terms is only a small slippage, nothing alarming. Now, asset turnover and the cash conversion cycle. This one ties everything together beautifully. Asset turnover is revenue divided by total assets, and the cash conversion cycle, or CCC, equals inventory days plus collection days minus payable days. For ABC Limited, asset turnover is 2,000 over 1,400, which is 1.43 times. The cash conversion cycle is 78 plus 37 minus 47, which equals 68 days. Think about what that actually means. That's 68 days where cash is locked up between paying suppliers and collecting from customers. And here's a great insight for you. Shortening this cycle frees up working capital without raising a single rupee of new financing. How would you shorten it? By turning stock faster, collecting sooner, or negotiating longer credit from your suppliers. Fantastic! One family left. Let's move to family number 5, market or valuation ratios. These ask, what is an investor actually paying for each rupee of the company's earnings and assets? We'll cover earnings per share, the price-to-earnings ratio, price-to-book, and dividend yield. Let's start with earnings per share, or EPS. Formula: net profit divided by the number of shares. For ABC Limited, 168 divided by 40 lakh shares equals 4 rupees 20 paisa per share. Now, the price-earnings ratio or PE ratio, market price divided by EPS. 63 divided by 4.20 equals 15 times. So what do these tell us? EPS converts total profit into a per-share figure an investor can actually relate to. And PE shows how many years of current earnings the market is willing to pay upfront for. Here, the market is paying 15 rupees for every 1 rupee of earnings. Now ask yourself, is a high PE always a bad sign? Not necessarily. It could mean high growth expectations, or it could mean the stock is simply overpriced. Always judge PE against the sector median and the company's own growth rate, never in isolation. And finally, let's cover price to book, dividend yield, and the payout ratio. First, book value per share, equity divided by shares. So 700 over 40 gives us 17 rupees 50. Price to book is 63 divided by 17.50, giving 3.6 times. Dividend per share is 50.4 divided by 40 equals 1 rupee 26 paisa. Dividend yield is 1.26 divided by 63 equals 2.0%. And payout ratio is 1.26 divided by 4.20 equals 30%. So what's each one telling us? PB compares the market price with the accounting net worth per share. Dividend yield is the cash return an investor gets each year on the price they paid. And payout shows how much profit is distributed versus retained to fund future growth. Here's a pattern worth remembering. Growth companies tend to keep payout low, while mature, cash-rich businesses often pay out 40 to 70% of profit. Alright, let's bring everything together now. Here's ABC Limited's complete scorecard, benchmarked against the industry average. On liquidity, ABC's current ratio of 2.00 actually beats the industry's 1.8. Good sign, though its quick ratio of 0.97 sits just slightly below the industry's 1.0. Worth watching. On solvency, ABC's debt equity of 0.70 is more conservative than the industry's 0.9, and interest coverage at 5.0 times comfortably beats the industry average of 3.5 times. On profitability, net margin is 8.4% and ROE is a strong 24%. On efficiency, asset turnover is 1.43 times with a cash conversion cycle of 68 days. And on market ratios, the PE is 15 times with a 2% dividend yield. So, what's our verdict? ABC Limited is profitable and well leveraged, but its quick ratio and its 68-day cash cycle are two things I'd want to keep watching closely. Before we finish today's lesson, I want to make sure you understand the limitations of ratio analysis. This is just as important as the ratios themselves. First, ratios are historical, not predictive. They describe the year that's already ended, not the year ahead. Second, accounting policy differences, like FIFO versus weighted average, or different depreciation methods, can break comparability between two companies. Third, window dressing. Year-end entries can flatter liquidity for just a single reporting date. Fourth, ratios ignore inflation and quality. 100 rupees of 2019 sales is simply not the same as 100 rupees of 2026 sales, and not every debtor is actually collectible. Fifth, seasonality can distort things. A December balance sheet of a seasonal business only tells you part of the story. And finally, ratios have no meaning without context. Always read them alongside the trend, the industry, and the notes to accounts. Here's how I want you to remember this. Use ratios as a torch, not a verdict. They show you where to dig. The notes to accounts tell you what you actually find. Great work today, everyone. Let's do a quick recap of what we covered. 5 families, 14 ratios, all built from one single set of financial statements. Liquidity, current ratio 2.00, quick ratio 0.97. Solvency, debt equity 0.70. Interest coverage 5.0 times. Profitability, net margin 8.4%, ROE 24%. Efficiency, asset turnover 1.43 times, cash conversion cycle 68 days. And market, EPS 4 rupees 20, PE 15 times. If this lesson helped you, please hit subscribe for the full finance series. It really helps this channel grow. And in our next class, we'll decode the cash flow statement the exact same way, step by step. See you in the next one.